Good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 24th. I believe this is the last one we're going to have this month. But we're going to go over a couple things that you guys have mentioned, and we'll see if I can't answer a couple questions. Well, I'm going to answer 4 questions for you guys. So the first question: why do you change what you said you would do in the commentary or trade findings and adjustments? So, Jim Kohler, why do we change what we said we're going to do in the trade findings or adjustments or the commentary? Because I found it interesting. There are about 3 questions, 3 emails, not questions, 3 emails that people asked me that, and I know you had a conversation with Keith. So Jim, why, or anyone, why do we change what we said we would do in the commentary, the trade findings and adjustments? Bueller, anyone? Ooh, so it's funny. I'm going to read 3 of these in a row. Here we go. Because you have no clue what you're doing. William, I'm going to remember that next time I place a new position in your account. Circumstances change. If the market isn't doing what you expected, you probably should change. Circumstances change from Jim Kohler. Right. The simple answer is because the market is a living, breathing, ever-changing, what do we want to call it? A living, breathing, ever-changing entity. What we're planning on doing tonight might have a change tomorrow based on news, circumstances, earnings, market reaction, Fed, war, China, other governments. I mean, there's a lot that can go on that what we say tonight changes. Or the thought was we were going to let Baidu run, and that quickly changed. That quickly changed to, you know what? Not going to happen. We need to get protection on to protect Baidu a little bit farther and a little bit better, and protect as it's going a little bit farther down. So that was the thought process for that one. All right. Number 2. And I think number 2 is pretty interesting. I should do it this way. What is going on right now in today's market? And this one probably goes back a couple weeks. And it's going to move into the future. So if someone was to ask you what's going on right now in today's market, what would you think? And what would you say if you were me? If you were a money manager, QU, QE, quantitative easing. So it could be QE from the Fed as they bailed out the banks, right? What else, though? Because I find it interesting that if I can make my comment, ooh, I like that one. Earnings mixed, layoffs, and I'm going to just throw another thing. Layoffs suggest recession, right? I mean, the reality is nobody knows unless you are making something up to get more TV time. I mean, the reality is right now we're worried about interest rate hikes, right? So we have interest rate hike worries, which will happen next week. Should be what, next Wednesday? May 3rd. May 3rd, we're probably going to go up another quarter point, and we will probably not hear the Fed say that they're going to stop. I was going to say something else, but my thought process is the fact of the matter is, once again, we are in some uncharted territory. If I was to suggest something, the fact of the matter is, I really don't know. If I was going to talk about things to look out for, it would be the Fed, not necessarily earnings. We do have to remember that this week we are having the majority of the FANG stocks, right? Facebook, which is Meta, reports this week. Microsoft reports this week. Amazon reports this week. Google reports this week. Apple reports next week. So we do have 4 of the 6 FANG stocks. Netflix was last week. It didn't go over well. We've got a big week that's going to basically try to find out or justify, do we have growth in earnings in the cash heavy technology? Are we going to enter a recession with the layoffs? It's really not looking great, but most important thing, Fed rate hike quarter point, and chances are they are not going to say that they're going to stop. We are in a bit of a reactionary market right now. We are reacting to what the market's giving us. And we don't have, I mean, if you say you see a trend, I'm curious to know what trend that is. All right, number 3. Why are you always saying, how would I say it? Well, it's work the numbers. And I'm just going to say, using the Ronald Reagan, trust but validate, right? Trust but validate. This is pretty simple. And this is why I'm telling you, you just can't believe everything you see or hear. There's a pretty neat article. Here's how much money you would have if you invested in the S&P a decade ago. And I saw this on April 21st. So it's a little bit old, right? Market was up Friday a little bit, well, actually a good amount. But here you go. This is why you work the numbers. This is why you don't buy the crap that's out there. Here we have Cheyenne Devon. So I'm writing him or her off as someone that doesn't know what they're talking about. If you invested in the S&P a year ago, your investment would be worth $942. 5 years ago, it'd be $1,689. If you put $1,000 a decade ago, it would have tripled to $3,217. I call BS. I went and I got the results from macrotrends.net, historical returns. Here they are. Oh, well, I thought I had them. Let's see if I do have them. And it's kind of embarrassing when you're all ready to show something and you don't have it ready. Really? Okay, give me a second. Man, I can't believe that I did that. That was not smart. I wonder if I can. Well, maybe I'm just going to redo it. All right. And I keep turning it down. So let me just show you what I did since I'm not being really smart here. Thinking I had something already taken care of, and I don't. So none of this is going to work, but I'm going to do it a different way. All right, and you guys just sent something in to me. That's why your advisor? Yeah. All right, can't believe I just did this. Just gonna grab it, copy, highlight, paste. It's not what I'm looking for crying out loud. Control C, Control V. That's okay. All right, so here are all those returns, which means if you had $1,000 through 2013, you're going to take that $1,000, you're going to times it by itself plus 29.6%. Your first year, your Your $1,000 grew to $296. Your second year, it's your $1,296, and you times it by itself, which is the 1.1139%. Your third year, you're almost down 1%. Not quite, but that's H10 times itself plus nope, it is itself, which is 1 minus the 0.073. It's down $10. Not bad, right? Next year we have another up market, which is times itself plus 9.54%. Another big year in 2017. It's compounding, times itself plus 19.42. 2018, it's your $1,874 now, times itself minus 6.24%, going back down. Whopper of a year in 2019. Did that one wrong. Times 1.2888. 2020. That was a pretty good year for us. Timesing itself and 16.26. Timesing itself times the growth of 2689. Oh, we're doing so good. And then we had last year, which is times itself 1 minus 0.1944. This is your ending number, $2,692. It's up 162% in 10 years. That is not what the article says. It says you'll be up $3,217. It is not accurate. It is not accurate for this year. If you add to April 20th, you add another 6.86%. It doesn't equal that. The numbers are not correct, which is why you work the numbers yourselves. You see if people are being honest or not. If you average it out, you get their numbers. But I've only said it a million times. Averages are not your friend. And they don't ever equal portfolio growth. Does that make sense to you? What I just walked you guys through, does that make sense to you? And William, you don't get to answer because I know it does. We talked about this today. Bill, Dee Dee, Jim, Russ, Lance, Dave, and David. Does that make sense to you, what I was showing you? Do those returns answer your questions there on why it's what's legit, what's not? Jim says yes. Thank goodness. All I'm doing is I'm working just simple numbers. I'm not doing anything other than that. If you want to add almost an extra $800 to the returns, you take those averages and just average them out year after year. That's how you get to 3,200. The article was not written accurate. The premise was wrong. That is the problem with, and last but not least, the problem with, how do I say this? The problem with financial plans. Boy, that was good spelling, huh? The problem with insurance that will pay for itself. The problem with the self-funding or infinite banking concepts. The problem with all these concepts, come on, they are based on compounding interest with a fixed average return. Can anyone tell me the last time the market gave you a fixed average return year after year? Can anyone tell me, has it ever happened? It's not there. Well, it's a flight plan and you'll change your direction. The numbers will never add up. You can't do compounding interest return on the stock market because it's a variable market. You can't borrow from your insurance at a I don't know what you call it, an average market return or a world index average return, because they don't give you a compounding growing average return every year. They're variable. And because they're variable, the whole premise of an average return, or the whole premise of that compounding interest for those financial plans, there has never been a financial plan in the world that has ever worked. There has never been a whole life insurance or universal life where you're going to borrow from the returns that funds your retirement because the cost of borrowing is just too expensive. And it's based on a return that does not exist. You don't get a compounding interest yearly return in the stock market, or when you're borrowing money on a credit card, 3+ prime. It just doesn't exist. Are there any questions on this? I'm thinking there's not going to be, but I just needed to ask. Okay, pretty interesting. I don't know where the growth is going to come this year. If we're thinking about it, banks, Bank of America and JP Morgan did really good. But banks as a whole and financials are not. We'll find out Visa this week. But there's a lot that we don't know for an answer that, how do I say it? We're just not getting a sector or an industry that is growing. Someone said, well, Kevin, what about what did they say? The tourist industry. That's growing. People are traveling more. Well, the industries are technology, healthcare, financials, real estate, energy, materials, consumer discretionary, industrials, utilities, consumer staples, and communications. There's not I don't know. You don't have a tour section that's going to take over any of these other sections. Well, Kevin, technology. Netflix blew it. We might have a real bad Google. Amazon shouldn't be doing really good. We might have a really, well, Microsoft should be doing good though. Roku will find out this week. Apple will find out next week. There's nothing that's standing out, especially with the chip shortage, is that we're going to have a whole lot of growth in any one sector right now. Our best bet's technology. Healthcare can't meet the comps of the COVID years. So healthcare doesn't look really good. Financial should be doing good, but banks are collapsing. Bank of America did good. Goldman Sachs did awful. JP Morgan did really good, but not Goldman Sachs. Morgan Stanley did awful. There's stuff all across the board there. Real estate, home prices seem to be coming down a little bit. At least mine has. Energy seems to be flat. Materials, I actually don't know. Consumer discretionary, we seem to have less money with higher inflation that's going farther. I'm not spending a whole lot. Industrials, I don't see a lot of growth. We still have labor shortages. Utilities, I'm actually not sure. Consumer staples might do good, and communications probably won't do really good. So I don't know where the growth is going to come from, but I would bet technology. With that said, Meta, Apple, Microsoft, Google, they're all coming this week and next week. IBM was last week, was not spectacular. Those are areas I think we need to pay attention to see if we're going to get some growth. But right now, I don't see it. I don't see the growth. We may not have to get the growth at the end of the year. With that said, our earnings are out here. Bank of America was last week. Lockheed Martin was last week. Coke was today. Coke actually knocked it out of the park. I almost wanted to sell Coke off, but we don't need the money right away. And boy, Coke's moved over almost 10% since then. All right, here we go. The big picture. I really did like it. I was going to scroll down, but the short answer is recession is coming, but it will have to wait. Today, or well, no, I guess not today, but this week, we have our GDP numbers. GDP is supposed to be 2.0% growth. I think it'll come in less than 2%. But 2.0% is the expected GDP growth. It just seems like we're going to mosey along slowly but surely. I did like the last paragraph. Guess it's the second to last paragraph. To be sure, a recession is coming and is part of the business cycle. When it is coming is open for debate, and what profile it will have, deep or shallow, is going to hinge on labor market trends. I thought it would have hinged on, in all honesty, on interest rate hikes. But we don't know. We don't know exactly what it hinges on. It'll be interesting to see where we end up at. All right. Market still bullish, moving sideways for the last week in a tighter range. S&P still moving sideways in a little bit more open range than the Dow Jones. The NASDAQ moving sideways. April was a pretty crappy month. But I'm going to tell you, this week if we get bad earnings, we're going to test the 4,000 range, which will put us at about a 2 to 2.5% downside month for the market. Tons of earnings. They're all listed there. This week for economic reports, new home sales tomorrow and consumer confidence will be important. Durable goods on Wednesday will be important. GDP on Thursday will be important. Personal income, personal spending, and PCE prices, all inflationary reports are going to be important. For the next 4 days, we're going to be run by, in the morning, the economic reports, and then earnings in the afternoon. No joke, we could see our market go down 8% in this week. We might also see it go up 8%. All based on what we see in our markets and where it goes from start to finish. All right. Interesting article. Is a rolling recession helping the market? I'm not going to comment on this. I'm going to let you guys read it tomorrow and tell me what you think, if a rolling recession is helping the market or not. I find it interesting as they use certain points to justify movements up or down. Russian-Ukraine war, non-profitable tech and crypto, Fed rate hikes, SPACs and IPOs, Powell, more rate hikes, regional bank crisis. It's a very interesting article that, again, gives you so much to think about. You truly don't know what to think. I mean, it is somewhat ridiculous, but definitely something to go through and to take a look at. All right, what else do I have for you? Should investors buy regional bank stocks? A bull and bear weigh in 3 top picks. I would not be buying regionals right now. The top picks, First Third, Bancorp, and First Citizens, are the top 2 picks, actually. I would agree with that. Southern First Part said we go for bigger banks, JP Morgan and Bank of America. I have this article because I also believe the bigger banks are going to be better than the regionals. Disney's cutting jobs. Why was Disney up today in a pretty weak, floppy market? Because they're laying off 4,000 more workers that they don't need. Apple expands financial service ambitions. Another blow for banks. Right now, high yield savings account interest rate of 4.15% through Apple is about the best and safest out there. And then I have that article. Here's how much you'd have if you invested $1,000 a decade ago. I worked all the numbers on that. Questions for me. What questions do you guys have that I can answer for you? Let me give you guys a second for questions. What questions do you guys have that I might be able to answer for you? Maud Spencer, I noticed you guys joined in. Do look at my Hurley Investment, singular. Look at my Hurley Investment tomorrow. Dave should have these posted, so definitely look at my Hurley Investment and let's get these posted so that you guys can see what you missed today. I think I had some really good stuff. Any questions you guys have? William, what would be your top pick? Right now, if I was looking to invest more money into positions, I'd probably have a tie looking at Apple. Second place, and a very close second place, would be Disney. I think Disney's doing all the right things again, where they are laying off the fat of the company. They've got more movies coming in. I would think Disney's a good opportunity to double in value, which I don't think you have that same opportunity with Apple, but I think you'll get a good return on Apple this year. Third, and it's going to be a distant third, but third, a distant third is going to be Baidu. China's coming back. China's growing. China will probably have better GDP numbers towards the end of the year. So I think you'll have a lot of opportunity in Baidu on another stock that could double, but it is a distant third. So there's my top 3. If I was going to invest new money right now, Apple would be my first pick. Disney would be a very close second pick. And then third, which is a distant third, would be Baidu on China. I just don't know how China numbers are going to come in. So, William, I hope that answers your question there. Any other question? Oh, yeah. So, William also, we had a talk today. William also asked, Kevin, I noticed you're not doing a lot of leap calls. In the past, we've run a lot of leap calls that have made some great money in bullish markets. Last year, leap calls really hurt us. And I'm not running a whole lot of other leap calls. I know I'm doing a minimum amount in Baidu. I'm doing a pretty good amount in JP Morgan. Yes, I do like Boeing, but it's just they still can't get it done right. So I am not running leap long calls that are expensive this year where we don't have a clear direction. Well, Kevin, the market's up 7% this year. I know that. But out of that 7%, like 3.5% of it is Apple. So I'm not really ready to bet money on something like that. So that's where I'm at in that regard. William, did that answer both your questions? Anybody else? Anybody else have any questions? If I don't see one come in the next 10, 15 seconds, thank you guys for being here. Hopefully that was helpful for you to be able to see what's happening and what we're looking at, why, particularly on Thursday, Keith said, you know what, we'll probably take some put protection on to then or keep put protection off, but then we put it right back on again on Baidu. All right, I don't see any questions coming in. Guys, thank you for being here with me today. I appreciate your time. I look forward to seeing you guys next week. Have a good week, and let's see where some of these big FANG stocks come in for earnings this week. See you then. Bye-bye.